Hi, Harry here on Delayed Rant on Monday, September the 11th. I've been traveling heavily. I'm up in New York doing a lot of things, by the way. Medical, business, everything. Here's where we're at again. The story continues to be this lengthy bounce from the first crash in 2022. Now, you know how long I was waiting to see a big enough crash to say that the second major stock and real estate bubble this time together was finally over, okay? We got 38% in the NASDAQ. That fit the bill. 28% on the S&P 500. Barely but fit the bill. But now we've had this bounce that just goes on and on. It's going on 10 months for the S&P 500, more like 8 months for the NASDAQ. I mean, this is getting long in the tooth. And we have not been able to make a new high, and I still think we probably won't. So it's very important here to watch the stock markets. I think they're the most important indicator. The S&P 500 has reclaimed 80% of its crash, okay, in the late July top recently. And I think that might have been the top in the bounce. Most likely it was. Here's the clear diverging sign I've been talking about. The Russell 2000 small caps have only reclaimed 45% of their crash loss. And the NASDAQ in between, closer to the S&P. So that's the screaming divergence. I don't want to see new highs in the S&P 500. And if we do, I only want to see it in the S&P 500. And then have all the other NASDAQ and Russell 2000 small caps not make new highs. And that creates another divergence. So I know this bounce has been long. It's frustrating for people that are either have gotten out of stocks or short stocks or long the bonds through TLT. The 20-year average treasury bonds, or Zeros 25-year average, or TMF, which is triple the TLT. But you have to be patient with these. This is going to be the biggest move in history. As you know, I've been projecting that once we bottom somewhere at 91.85 or just below at 89 or maybe just above now at 94-ish recently, this thing is set to run to new highs. About 186 is my best projection. This is going to be the biggest rally in a short period of time, say a year and a half or less, in treasury bonds ever passed, and I think for decades into the future. And of course, the big illusion here I've been talking about now for many, many months, that everybody's saying, well, the economy's strong. Look at all this tightening, 525 basis point, and it's not weakening that much. This is a matter of the lags, okay? The biggest stimulus short-term in history was $5.2 trillion between COVID in early 2020 and early 2022 when they finally backed off, okay? $5.2 trillion, that's 25% of GDP poured in 2 years. So that is still hitting. That's why the tightening and raise of 525 basis points, and we may get 550 just ahead in November, possibly. I think maybe not by then, but it doesn't matter. This is the biggest hike in 4 decades, and it doesn't seem to be happening. It's because the stimulus was so strong. Here's the most important point, and that's why we have to watch the bond market, the treasury bonds, and the stock markets very closely, and it is a good time to be out now of stocks and starting to get into the bonds as a safe haven, okay? It's because we're going to see that 5.2 trillion wear off increasingly from about now into late 2024 on that 1 to 1.5 year lag. And we're going to see the tightening, which is just peaking now, continue to hit on a 1.5 year lag, same time period, into mid to late 2024. So all the trends are down. Don't be fooled thinking, oh yeah, the economy's strong and maybe we have a soft landing. Hey folks, soft landing never ever happened, okay? It may happen sometime. This is not the time. We have unprecedented levels, unprecedented stimulus wearing off and rapidly flipping to tightening, as I said earlier. There's no way we can go but getting weaker. And my point of view is the opposite of what most people think about the market. The markets are fundamentally at their lowest ebb since the baby boomers peaked in 2007, something I called way before. 2008 was the beginning of what could have been a Great Depression. All this stimulus offset that, but there's a price to pay for that, okay? So stimulus has diminishing returns, and we're going the other way now. I see no way the economy does not weaken substantially, and I think since it's fundamentally weak underneath, at the bottom of the baby bust cycle before millennials turn up in the next year or two, that the economy is not going to react well, and it's going to go down faster than people think, and that's what's going to catch the Fed. So stay tuned, watch the markets. Good time to be out of stocks, continue to be. Good time to be starting to buy them on. Remember that the TLT and TMF and ZEROs, the treasury bonds, they will edge up in the early stages of this downturn as now, but they will explode the most at the worst. So that's why you really gotta hold those. I'll keep you updated.